Hello everybody, it's Tortoise Investing coming at you today with another 5 dividend stocks that you can buy and hold forever. I do these weekly, and here recently I started a thing. I let a randomizer pick what stocks I buy through my Schwab account. So if any of those things sound interesting to you, or if you want some more dividend love in your life, make sure to hit that like and subscribe button. Let's grow the channel and our portfolios together. Let's get that march on to 1,000, and let's just keep on keeping on. Now, without further ado, the stocks we're going to be taking a look at today. We got Lockheed Martin, Hershey Company, Tractor Supply, General Parts, and Bristol Myers Squibb. So let's take a look at the finances behind these. Lockheed Martin, we got adjusted free cash flow yield of 5.09%, got a dividend yield of 2.58%, a payout ratio of 52.99%. The revenue over the last 10 years, slow and steady, been increasing at a rate of 3.41%. The free cash flow has been increasing at a rate of 25.77%. Very nice. You love that free cash flow to be going up and to the right. That is a great sign of a great company. The EPS has been increasing at a rate of 9.36% over the last over the last 10 years. They do have some debt at $15 billion. Their EBITDA is $8.71 billion. So no problem there whatsoever. When it comes to stocks and holdings, I don't like there to be 3 times more debt than there is EBITDA, and this definitely falls in a range of like right around 2, so no problem there whatsoever. The dividend's been increased at a rate of 10% over the last 10 years, and Lockheed Martin's been increasing their dividend for the last 20 years, so a very nice compounding going on there. The shares outstanding slowly have been doing share buybacks, but not too many. I would like to see that increase personally, but that is A-okay. And the return on capital employed has been reliably above 20% since 2018. So that's another thing I like. Companies with a strong return on capital and great cash flow. And Lockheed Martin hits both of those. Lockheed Martin was off a recent high of over $500 a share, so it is down about 9% or so from its recent highs. So maybe a good buying opportunity. Now, this is financial advice, entertainment and educational purposes only. Next up, we got the Hershey Company. I really like this company. I am waiting to see if it drops down to around the 200s. A little bit lower than where it is right now, but it is a strong moat, and recently was around 274, 275 area. So it might be something you want to put on your watch list. I think it's a great buy and hold forever stock. It's got adjusted free cash flow yield of 3.68%, has a dividend yield of 1.73%, and a payout ratio of 48.65%. Over the last 10 years, the revenue has been increasing slow and steady at a rate of 4.6%, but here recently, this has accelerated over the last 2 years at a rate of 13%. Take a look at the free cash flow. Free cash flow over the last 10 years has been increasing at a rate of 8.27%. Again, here recently, it has jumped about 20% over the last 2 years. EPS increase at a rate of 10.21%. I'm all over the place. And again, accelerating over the last 5 years, 16%. So they are doing things right. Growing EPS is a growing company, and you got free cash flow growing with that. And they're paying down their debt. They got $3 billion in debt. Their EBITDA is $2 billion, so no problem there whatsoever. And that dividend's been increasing at a rate of 9.45% over the last 10 years. Again, a great compounder. And they've been growing that dividend for the last 13 years. So a very nice little streak. They have been doing share buybacks very slowly. Again, same thing with Lockheed Martin. I'd like to see this accelerated, but ain't going to hate on it. It's got a super big moat. I really like Hershey. In 2020, it dipped below 20% at 19% return on capital employed, but it is ticking back up, and I like that. They do have an earnings at the end of the month, so if this is something that you want to put on your watch list and see how their earnings report goes, those have been wild for companies this year. On a good earnings, a company can drop for some reason. So if you want to wait and maybe get a better buying opportunity, you can. If you want to just DCA into it, I don't think it's a bad company whatsoever. Next up, Tractor Supply. I own this in my portfolio. It's got adjusted free cash flow yield of 1.87%. It's got a dividend yield of 1.29% and a payout ratio of 38.99%. Now it's off its recent high of, what was it, around 250, right at the 250 mark, down to 214, 215. So again, it's dropped off of its recent highs. That's one thing I try to do. I try to bring in stuff that is either off its recent highs or it's still got good value. I know the market's been running, but there are still really great buy and hold forever stocks out there. You just got to know where to look. Over the last 10 years, revenue has been increased at a rate of 11.78%. The free cash flow has been increased at right at 10% over the last 10 years. Very, very nice. And the EPS growing rapidly at a rate of 17.5% over the last 10 years. They do have a little bit of debt, $814 million. Their EBITDA is $1.7 billion. So no issue whatsoever. The thing I really love about Tractor Supply, this is growing, EPS is growing, and they got low debt. I love that. Dividend, they had this huge increase here back in 2022. So over the last 10 years, been increasing at a rate of 23%. It looks like they were doing smaller hikes of around, what was that, about 15%. So maybe that's something we can expect going forward. I'm not sure, but all I know is this is a really big stair-step ladder, and they have been increasing that dividend for the last 14 years, so something I intend to hold for a while. They're doing more share buybacks, which I like. Another reason why I love this company so much, over the last 10 years, they've been decreasing their share count by a rate of 2.57%, and it looks like that they are increasing the amount of shares they buy back. So I love to see that. And the return on capital employed since 2019 has done nothing but grow, and it is over 23% right now. So love it, love it, love it. So many good things to say about Tractor Supply. Next up, we got Genuine Parts Company. They got a free adjusted cash flow yield of 3.75%, got a dividend yield 2.29%, and a payout ratio of 41%. So take a look at the revenue. Revenue's been increasing at a rate of 5.44% over the last 10 years. Slow and steady, but again, over the last 2 years, they've been increasing their revenue streams. So very nice. Free cash flow has been increasing slow and steady. Over the last 5 years, been increasing at a rate of 11.36%. Again, growing revenue, growing free cash flow. Like to see it. Growing EPS. Over the last 10 years, growing at a rate of 7.2%. Again, they had the 2020 hiccup. Everything had the 2020 hiccup pretty much. I really, really do like this company as well. This is a great, probably one of the better auto part related companies out there. They do have some debt at $3 billion. Their EBITDA is 1.99, pretty much $2 billion. So no issues there whatsoever. They've been increasing their dividend at a rate of 5.87% over the last 10 years. Now, the really cool thing with this company is how long they've been increasing their dividend. 68 years. Oh my God. This company has been increasing their dividend through wars, through the dot-com bubble, through the financial crisis, through COVID, through everything. And they just keep trucking. Share buybacks is something they don't do too much of, but they have been buying them back slowly but surely over time. And the return on capital employed is growing. Was at 13%, is now up to 18.69%. And again, it's a nice little up and to the right. So GPC, another great company in my eyes. Next up, Bristol Myers Squibb. This company is beat all to pieces, and it might be a great buying opportunity. Let's take a look at it here. Looks like they were recently around $74, $75 a share, now down to $61.94. A lot of healthcare stocks are beat up right now. Maybe a great buying opportunity. Again, not financial advice. I'm not telling you to go out there and buy these. Just letting you know that there are still some great deals out there. So dividend yield of 3.66%, payout ratio 64.69%, right there in the sweet spot. You don't want it much higher than that, but that is not an issue. Revenue has been increased at a rate of 10% over the last 10 years, so very nice. Free cash flow been increasing as well at a rate of 6.45% over the last 10 years. EPS has been increasing their rate of right at 10%, 9.76% over the last 10 years. They do have some debt at $34.9 billion. Their EBITDA is $19.9 billion. So again, no issues there whatsoever. Dividends been increasing at a rate of 5% over the last 10 years, slow and steady. They've been increasing their dividend for the last 16 years. So again, a nice little compounder. And the return on capital employed, not the best in the world, but you know what? It is growing. So yeah, those are 5 dividend stocks I feel that you can buy and hold forever if any of those interest you. As always, make sure to do your own research and things before you go out and just purchase whatever. But that is the video for today, guys. Thanks for watching. Make sure to hit that like and subscribe button for more. And until next time, see yins.